Imagine looking at a stock that was, flying high near $28 just a few weeks ago, and then you just watch it completely fall off a cliff down to $3.
It is a brutal chart to look at, honestly.
Right. I mean, is Battalion Oil Corporation trading under the ticker symbol BATL the ultimate undervalued opportunity? Or is it a falling knife wrapped in a value trap?
That's the million-dollar question.
Exactly. And that is exactly what we're deciphering today in this deep dive. We're using their latest SEC filings, their full year 2025 results, and a flurry of strategic transactions as we sit here in late April 2026.
There is a lot of data to get through.
There totally is.
Yeah.
And if you are navigating these kinds of market traps with us, make sure you like the video, subscribe to our YouTube channel, and compulsively leave your comments and feedback below so you never miss our next breakdown.
Yeah, but before we dig into the tape, I actually need to jump in right here at the top to make something crystal clear to you listening.
Go for it.
Everything we are about to discuss is a natural, analytical debate about the data we've gathered from these sources. This is absolutely not financial advice.
Definitely not.
We're just mapping the territory, looking at the numbers, and, exploring the arguments. We are not telling you what to do with your money.
Absolutely.
Yeah.
We are here to decipher the data, not your portfolio. And before we can even begin to debate if this stock is a screaming buy or a dangerous trap, we have to look at the sheer scale of the recent price action.
Because it's breathtaking.
Breathtaking is the word. As of our April 17th to 21st window, the current price is sitting right around $3.13.
Yeah.
But flashback to March 3rd, 2026. This stock hit an all-time high of $27.68.
Just a massive drop.
Right. The 52-week range spans a dizzying low of $1 all the way up to $29.70. And the market cap has completely shriveled down to about $63.35 million.
It's basically evaporated.
It has. And the short interest, 19.05%. Okay, let's unpack this. A drop of nearly 90% in roughly 6 weeks.
Yeah, it's like stepping out of a speeding car.
Seriously. With almost a fifth of the float actively shorted, are the bears just, taking a well-deserved victory lap here? Or are we looking at a trade that's getting perilously crowded on the short side?
Well, it's undoubtedly a crowded trade, right? But the sheer velocity of that drop tells us the market was aggressively repricing risk, not just, taking profits.
Yeah, that makes sense.
When 19% of the float is short, the bears are heavily convicted that the worst is yet to come. But you like to point out the danger of the crowding.
Because they have to buy it back eventually.
Exactly. The deeper a stock falls, the less room there is for the short thesis to expand before the risk-to-reward ratio just flips.
Right.
If any positive catalyst emerges, say a sudden operational update or a spike in oil prices, those shorts have to aggressively buy to cover.
Which shoots the price right back up.
Right. So while the fundamental thesis for the bears might be solid, technically, they are sitting on a powder keg of potential volatility.
Okay. But if the fundamental setup is that disastrous, it completely explains why the shorts are piling in. You can't understand a crash of this magnitude just by looking at a stock chart or short interest.
No, you really have to dig into the numbers.
Exactly. To see why the bottom fell out so violently, we have to open up the company's ledger and look at the actual cash. And looking at the income statement, it's kind of this mystery of vanishing momentum.
Yeah, the Q4 drop-off is severe.
It really is. For the full year 2025, total revenue was $166.04 million. But if you zoom in on just Q4, they completely stalled out at $32.27 million.
Which is a huge red flag.
Yeah, and that top-line stall directly dragged their quarterly net income down. Like, full-year net income looked ostensibly okay on paper at $11.8 million.
Right, on paper.
But Q4 saw a nasty net loss of negative $12.54 million. And here's the metric that really punishes the individual investor.
The EPS.
Yep. Earnings per share was negative $2.24 for the year and negative 76 cents in Q4 alone. Adjusted EBITDA for the year was $45.5 million.
Yeah.
So why did operations suddenly become so unprofitable right at the end of the year?
Well, because revenue in the oil sector is only half the story. The bottom line was completely cannibalized by the structural costs of keeping the operation alive.
Okay, break that down for me.
Sure. When you look at the balance sheet, Total assets sit at $460.68 million.
Which sounds pretty good, right?
It sounds robust until you look at the liabilities. Their debt is sitting incredibly heavy at $212.33 million.
Oh, wow.
Meanwhile, their liquidity, like the actual cash on hand, was just $28 million at the end of December.
That is a tiny cushion.
Exactly. Running an oil operation with this much debt is like trying to keep a leaky pipeline pressurized.
I like that analogy.
Right. Because no matter how much revenue you pump in at the source, the heavy capital expenditures required just to extract the oil, combined with massive debt service payments, well, they're venting all the pressure before it ever reaches the free cash flow valve at the end of the line.
And the data totally backs up that leaky pipeline analogy.
Mm.
They are burning cash at an unsustainable rate. We're looking at a negative free cash flow of $35.48 million for the full year.
Yeah.
And nearly $17 million of that burn happened in Q4 alone. But wait, I have to push back on your point about debt service for a second.
Okay, go ahead.
The data shows the company actually prepaid $40 million in debt in February 2026.
They did, yeah.
So if they're bleeding negative free cash flow and only have $28 million in liquidity to start the year, prepaying that much debt seems, I don't know, reckless.
It definitely looks that way on the surface.
Right, like paying off a credit card by emptying your emergency fund. Sure, lowering your ongoing interest burden is great in a vacuum, but didn't they effectively sacrifice their only safety net?
Yes, they absolutely did.
So, one bad operational month, and they are facing a severe liquidity crisis. Was the interest savings actually worth that level of insolvency risk?
If we connect this to the bigger picture, you're hitting on the exact paradox management is trapped in.
Right.
You're entirely correct that spending down precious liquidity to prepay debt drastically narrows their margin for operational error. It's a massive risk.
Right.
But look at it from their perspective. If you don't aggressively restructure and pay down that principal, the compounding interest on a $212 million debt load will just guarantee your insolvency anyway.
So it's a pick your poison kind of deal.
Exactly. They chose the acute risk of low liquidity over the chronic, certain death of suffocating interest payments. They managed to narrow their net losses year over year, which shows the strategy is having some effect.
But negative free cash flow means the clock is always ticking.
Yes. They're making a desperate bet that they can streamline operations fast enough to survive the liquidity squeeze.
Man. So we have a company with decent hard assets, but they are bleeding cash and purposefully draining their own liquidity to try and outrun a massive debt load.
Yeah.
If the fundamental reality is that fragile, how are the algorithms and the technical traders reacting? Let's move over to the technicals.
Let's do it.
The 14-day RSI is sitting at 37.80. That is technically neutral, but it's creeping dangerously close to oversold territory.
Yeah, very close.
And the MCD histogram is at negative 2.0, deepening into negative territory, which is showing us that the downward momentum isn't just continuing, it's actively accelerating.
The momentum is terrible right now.
It really is. And the moving averages show the pure velocity of this crash. The 5-day moving average is at $3.43, signaling a near-term sell.
Right.
The 50-day moving average is a towering $8.17, flashing a strong sell.
Just miles above the current price.
Exactly. But the 200-day moving average is sitting right at $3.01. We're resting literally pennies above a historic long-term support level.
Which is a crucial line to watch.
Totally. Plus, key resistance is overhead at $4.48, and then again at $6.09. And honestly, analyst consensus is a resounding hold or sell across the board.
Yeah, no one is really pounding the table to buy this.
No. And then we have the insider activity. Walter R. Mayer proposed a sale of securities in March 2026. Here's where it gets really interesting.
Okay.
We are watching a massive psychological war happening right now at this $3 support line. It's the ultimate line in the sand. But if a core insider is heading for the exits right at the floor, why on earth should the average retail trader step in to try and catch this falling knife?
That is the exact question scaring every contrarian trader in the face. Insider selling at the absolute bottom of a 90% crash is a glaring red flag.
It just looks so bad.
It does. I mean, insiders sell for a myriad of personal reasons. Sure, maybe they're buying a house, whatever. But when you pair an insider sale with a severely compressed liquidity profile and negative cash flow, it signals profound internal caution.
They don't believe the turnaround is imminent.
Right. It implies the people with the most visibility into the company's day-to-day operations aren't holding their breath for a miraculous V-shaped recovery.
Wow.
And going back to those technicals, the gap between the current price and that 50-day moving average of $8.17 is crucial.
Why is that gap so important?
Because that gap represents institutional abandonment. When a stock falls that far below its medium-term trend, any upward movement is going to face intense selling pressure.
Oh, because trapped investors are just waiting to get out.
Exactly. They use any bounce to finally exit their positions at a smaller loss.
I hear that. However, there are definitely people willing to take the other side of this trade. Because if you read the analysis in the market chatter right now, you see two completely divergent realities being pitched.
Oh, absolutely.
Let's lay out the bull case first, the absolute best case scenario. The bulls are looking squarely at a massive strategic move in March 2026. Battalion acquired 7,090 net acres in Ward County.
Which is a significant chunk of land.
It is. They also point to that $40 million debt reduction we just debated as a sign of financial discipline.
Right.
And crucially, production at their core Monument Draw asset is up nearly 30% since December 2025.
Yeah.
That isn't just financial engineering. That is real, tangible operational growth.
True, as real oil coming out of the ground. But the bears counter that growth narrative with the brutal reality of execution risk.
Okay, what's their angle?
The worst-case continuation scenario focuses on the fact that growth requires capital. And as we established, Battalion is severely cash-constrained.
Right, they barely have any liquidity.
Exactly. To survive and fund these moves, they had to execute a $15 million equity raise in March 2026.
Which directly dilutes the existing shareholders.
Yep. Furthermore, the bears highlight the operational fragility. Battalion recently suffered an AGI facility outage that completely curtailed 4,300 barrels of oil equivalent per day.
Wait, let's pause right there because I want to make sure we truly understand the scale of that outage.
Okay.
What exactly is an AGI facility, and why does an outage there force them to stop pumping oil altogether?
That is an excellent question. AGI stands for acid gas injection.
Okay.
In places like the Permian Basin, extracting oil often brings up a highly toxic byproduct called sour gas. And this gas is laced with hydrogen sulfide.
Which sounds incredibly dangerous.
It is lethal. You can't just vent hydrogen sulfide into the atmosphere. It's highly illegal and extremely dangerous.
Obviously.
So oil companies use AGI facilities to capture that toxic gas, compress it, and safely inject it deep back underground.
Okay, I'm tracking.
So if the compressor at the AGI facility goes down, your entire production line has to be shut in immediately because you literally have nowhere to put the toxic gas. So it's a critical bottleneck.
Yeah.
If the disposal system breaks, the revenue system has to stop.
Exactly. And to put that 4,300 barrels of oil equivalent per day into context, Battalion is not a massive supermajor.
Right.
That curtailment represents a huge percentage of their total daily production.
That hurts.
When your margins are already razor thin and your cash flow is negative, a sudden mechanical failure that wipes out a massive chunk of your daily revenue can be financially devastating.
Yeah.
That is the execution risk the bears are focused on.
Man. Which brings us to the trap, the whole valuation debate. Because this is where the bulls and bears are looking at the exact same numbers and drawing wildly different conclusions.
Yeah, the value trap debate is huge here.
Bulls look at the screener and say, hey, the market cap is barely $63 million, but they hold $460 million in total assets. The price-to-book ratio is insanely low, therefore it must be undervalued.
It's a classic fundamental trap. Right. But the bears point out a glaring roadblock on the balance sheet. $226.24 million in preferred stock equity.
Yeah.
So what does this all mean? The way I see it, the capital structure of Battalion Oil is like a really exclusive nightclub.
Okay, I like this.
The preferred stockholders are the VIPs. They get to skip the line, they get the comfortable booths, and they get the premium bottle service brought to them first.
Yep, they get paid first.
Meanwhile, the common retail stockholders are stuck outside in the parking lot in the rain, just hoping the VIPs leave a few crumbs behind when the night is over.
What's fascinating here is how accurately that VIP analogy maps to the legal reality of the capital stack.
Really?
Oh, yeah. This is the precise mechanism that traps retail value investors. They run a basic fundamental screen, see a massive disparity between market cap and total assets, and think they've discovered a hidden gem.
Like they outsmarted Wall Street.
Exactly. But they are failing to calculate how heavily diluted their claims on those assets actually are. That $226 million in preferred stock equity represents a senior claim.
Meaning they are at the front of the line.
Yes. Whether the company is liquidated in bankruptcy or whether it simply generates a profit, those preferred shareholders get paid out long before a single dollar reaches the common shares.
Which completely explains the bizarre disparity on their income statement.
Yep.
Earlier, we noted that they actually reported a positive net income of almost $12 million for the full year. Yet the earnings per share for the common stock was negative $2.24.
It's crazy when you look at it that way.
The VIPs took all the profits in the form of preferred dividends before the math ever trickled down to the common denominator.
Precisely. The headline net income number creates a false sense of security, but the EPS reveals the structural disadvantage of the common shareholder.
That is rough.
And the dilution risk doesn't even end there. You also have to factor in the warrant issuances attached to those recent capital raises.
Oh, right, the warrants.
Warrants basically act as a ceiling on the stock price. If Battalion's operational turnaround is successful and the stock price begins to recover, those warrant holders will just exercise their rights to buy shares at predetermined prices.
Which instantly floods the open market with new supply.
Exactly. It aggressively caps the upward momentum of the stock. The common shareholder slice of the pie is constantly under threat of being sliced thinner.
It's a brutal headwind. I mean, retail traders get caught trying to bottom fish because they anchor their psychological expectations to that $27 all-time high.
The anchoring bias is so dangerous.
They think if it just recovers to a fraction of his previous high, I'll double my money. But the Battalion Oil that traded at $27 simply doesn't exist anymore.
No, it's a completely different company on paper.
The underlying share structure has been radically altered, the liquidity has been drained, and the debt service has entirely reshaped their financial reality.
That anchoring bias is exactly why this looks like a value trap rather than a value play. The intrinsic value of the common equity has been fundamentally degraded.
It's not just a market overreaction.
Right. It's not just an overreaction to bad news. It's a mathematical repricing of their place in the capital hierarchy.
We've thoroughly mapped out both realities here. We've seen the best case recover, which hinges on extracting value from that new Ward County acreage and maintaining the increased production at Monument Draw.
Yeah, that's the bold dream.
And we've mapped out the worst case continuation, which looks like a relentless death spiral of operational curtailments, negative cash flow, and endless equity dilution.
The bear nightmare.
Exactly. So where does that leave us looking forward? Let's talk about the specific outlook, starting with the short term.
Okay, near term.
Looking at the next few weeks, the technical data strongly suggests we are going to see a fierce battle for consolidation right near this $3 support level.
It's the big battleground.
It's the 200-day moving average, and the RSI is nearing oversold levels, which usually triggers some algorithmic buying. But we cannot forget that 19% short interest.
No, that's a massive factor.
In the near term, that guarantees extreme volatility. If management drops even a mildly positive operational update, we could see a violent temporary short squeeze as those bears rush to cover.
Absolutely.
But let's be clear. Structurally, the primary technical trend remains definitively bearish.
And shifting to the medium and long-term outlook, Battalion survival is no longer about financial engineering. It is purely about operational execution.
They just have to dig their way out.
Yeah. They've secured a new midstream provider, and it is absolutely vital that they sustain record throughput with them. Every barrel counts right now.
Because they need the cash flow.
Exactly. Furthermore, they have to seamlessly integrate that 7,090-acre Ward County acquisition into their production pipeline. But here's the ultimate catch. They have to execute this capital-intensive development without resorting to further massive dilution.
Meaning no more $15 million equity raises that just print millions of new shares and shove the common stockholders even further back in the parking lot.
Exactly. And this raises an important question regarding management's strategic foresight.
What's that?
Do they have the operational discipline to fully integrate these newly acquired assets without turning back to the capital markets for a bailout?
That's the real test.
Because if they hit a geological snag in Ward County, or if they suffer another mechanical failure at the AGI facility, Their liquidity buffer is practically non-existent. They will be forced back to the well to raise cash.
And raising cash at $3 is a lot different than $27.
Let me tell you, the terms financiers demand when your stock is desperately hovering at $3 are going to be exponentially more punishing.
It's the ultimate negative feedback loop.
It really is.
The lower the stock drops, the more expensive and dilutive it becomes to raise the money needed to save the company, which in turn forces the stock price even lower.
Yep, it's a vicious cycle.
Well, we've dissected the breathtaking crash. We've dug deep into the mechanisms behind the cash flow burn. We've debated the hidden dangers of the preferred equity value trap. And we've charted the narrow path management has to walk.
We covered a lot of ground today.
We did.
Huh.
But I want to leave you with a provocative final thought to mull over as you watch this ticker. You're looking at the chart, and you see that historical $3 support level acting as the absolute floor.
Right.
But if that psychological line in the sand breaks, where does a true fundamental floor actually exist for a company burning this much cash with this much senior debt?
That's a scary thought for the bulls.
But conversely, the market is an unpredictable beast driven by human panic. What happens if a sudden, unexpected piece of incredibly positive news hits the wire tomorrow for a stock where nearly 1/5 of the entire float is aggressively betting against its survival?
That's the powder keg we talked about.
Exactly. In a high-stakes standoff between cash trap management and over-leveraged short sellers, who gets squeezed first?